Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, everyone, U.S. stock futures kicking off the start of the March trading here in the green ahead of a big week for earnings. Economic data and tariffs, that's on deck. And, of course, the S&P 500 starting the month barely in the green as we're taking a look at futures right now, holding up on those fractional gains. This after wiping out nearly all of its gains this year while global stocks have outperformed. Traders will be on watch for February non-farm payrolls, which will provide the latest insight into the health of the labor market and could fuel growth concerns. Meanwhile, investors bracing for the imposition of tariffs, which would be among the most sweeping of the Trump era, applying to a roughly $1.5 trillion to annual imports there.
Plus, a number of retail earnings reports are set to be released here this week, with the likes of Target, Costco, and Abercrombie set to report earnings. Now, investors will be looking for any signs of a slowdown here in the consumer, as recent confidence data showed a decline in sentiment.
And Bitcoin is fluctuating today after its rally lost some steam sparked by President Trump's latest announcement on strategic crypto reserves. The president announcing that the U.S. will include three lesser-known digital tokens, XRP, Solana, and Cardano, will be added to the digital asset stockpile. The announcement comes as his crypto czar, David Sachs, prepares to host the White House's first industry summit this Friday. U.S. stocks look to kick off the month in the green. Outside of retail earnings this week, the big focus for investors will be Friday's payrolls report and, of course, the imposition of tariffs. That's going to be in focus. There you're taking a look at some of the companies that are going to be reporting over the course of this week. The setup here coming into this specific part of the retail earnings season is with the backdrop of us already getting the largest retailers, both online e-commerce and Amazon, and us already having Walmart out. So some of these names have already moved on the results that we've seen come through from those names, namely Target here. But most notably, I'd be watching for any further revisions that we see lower on the EPS front based on some FactSet data. We've actually seen larger cuts to the average EPS estimates for S&P 500 companies for Q1. The average is actually higher than the 5-year average, the 10-year average, and 15-year average, and the 20-year average, according to the bottom-up EPS estimate recorded during the first 2 months of the first quarter here. So that's going to be in focus here, especially as we get some of those names that just flashed across the screen.
Yeah, it certainly will be. I think you're seeing a bit of a relief here across the street as we do lead up to the opening bell. Of course, this follows the sell-off that we saw on Friday. You're seeing also some buying here in gold following the steep sell-off that we saw last week. I think the market's very much on edge. You're starting to see that here, paying closer and closer attention to some of that uncertainty coming out of Washington. Obviously, the threat of tariffs could potentially here be a massive market-moving event were they to go into effect tomorrow. And then, of course, looking ahead to the other econ data that we're getting out later this week with jobs, any deterioration there, any signs of any weakening on the heels of some of that slowing growth here on the economy and some of the latest readings and estimates that we're getting out here for GDP going forward. I think that could be a concern here to the market as they try to figure out ultimately what that means there for the Fed, the timing here of their next policy move. But again, I think there is so much uncertainty. Earnings helping to offset that to a certain degree. But again, when you take a look at these numbers, we are starting to see some deterioration. I think that is starting to be reflected here in the broader markets.
You talk about the jobs data that we're going to get. This is going to be really critical for the mindset of the consumer. Thinking back to last week in the Consumer Conference Board, Consumer Confidence Index number that we got that actually decreased by 7 points during February to 98.3. Within that, you actually got a look at how consumers are thinking about, and their view is about the current labor market conditions. That weekend during the month, consumers became pessimistic about future business conditions, less optimistic about future income. Pessimism about future employment prospects worsened and reached a 10-month high. So those all in consideration here, factoring into the consumer bullishness. And of course, that is something that will get a little bit of a read through once we get even more of the economic data on the labor market situation coming forward this week.
All right, let's talk about where Wall Street stands right now, because strategists are warning that the S&P 500's rally could struggle in the near term following recent volatility. Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. Sam, it's great to have you back here on Yahoo Finance. So obviously, we're coming off a week here where the market did send some troubling signs. We are looking at some buying action here ahead of the open. Help us make sense of that recent volatility that we started to see creep into the market.
Sure. Well, good morning, Sean and Brad. Basically, I think the market has been worried about the Federal Reserve, about interest rates, and also inflation and the pressures that it is putting on consumer confidence. And also, we've been seeing, as you mentioned earlier, very good Q4 earnings, now expected to be up 16% according to S&P Capital IQ consensus estimates versus the 8.7 initial estimate. But actually, that strength has been stealing from each of the four quarters in 2025. And instead of getting about a 12.5% growth rate expected for this calendar year, now it's down to about 9.5%. So, yeah, I think investors are a little concerned about the tariffs, what kind of an effect they will have on the economy and on inflation, and they're taking a wait and see attitude.
Sam, I wonder how you're evaluating a defensive play right now, because it seemed like, at least at the end of the last year, that defensive meant just go into technology because that was the long-term defensive play. But now you have some of those technology plays, Apple, NVIDIA, they've led some of these larger declines as well to start off 2025 here. So where are you thinking about the defensive plays that make sense right now?
Well, in last week's note, I said that investors are like fainting goats. You sneak up behind them and whisper, bear market, and their legs freeze, they fall over and are aligned into the defensive areas, consumer staples, healthcare, real estate, utilities. Also, we saw a surge in bond prices, a decline in bond yields in a flight to safety. Because the PCE number came in along expectations, I think investors did breathe a little sigh of relief. We got a relief rally as a result. But I think investors are still cautious. The greed and fear index right now is in the extreme fear area. Maybe in a short term that could represent a nice buying opportunity, but I think investors are truly concerned, and as a result, they're focusing on those groups where the demand for the products and services remains fairly static.
Sam, what happens if the tariffs are implemented tomorrow?
Well, if they are implemented tomorrow, my belief is that they will be around for a very short time. I think they are still more rhetoric than reality in terms of negotiating. I think that the president, in his State of the Union address, will continue to take a hard line and will try to call victory in some ways, whether it relates to the border, whether it relates to tariffs, fentanyl, et cetera. But I definitely think that if we do end up erecting those tariffs, they will be brought down fairly quickly.
What areas of the market do you expect that to reflect some of the, even if they're just interim or not long-term left on the table, but ultimately a negotiating tactic that then gets implemented, but then there's some quick resolution? Which areas of the market would feel the hit, at least on the onset?
Well, I think it's those groups that were leading to the downside as the S&P 500 was reaching the precipice of a pullback or a 5% decline, which we approached in the latter part of February. So the more cyclical areas like industrials, materials, consumer discretionary, which do have a lot of international exposure or at least are sourcing a lot of their goods from overseas. Technology also, because of the question in terms of tariffs, with China and also whatever kind of reciprocal tariffs there could end up being. So it does seem the only semi-cyclical group that it seems to be above it all is financials, and they have really been driven more so by the insurance stocks.
So when you take a look at the fact that growth trouble seems to be forming a bit, is it too early for investors to start worrying about a greater slowdown and shall I even say recession at this point?
I think it's too early to talk about recession. Granted, the stock market does tend to peak anywhere from 8 to 7 months before the start of a recession, and the market tends to bottom 5 months before the end of the recession on average. So, as the old saying goes, prices do indeed lead fundamentals. So, the market's action will indicate how serious concern is regarding the health of the overall economy.
Sam, thanks so much for taking the time here with us pre-market. Good to see you.
My pleasure. Thanks.
Front of mind for investors this week are looming tariff deadlines, with levies on Canada and Mexico set to take effect tomorrow, and the February jobs report that comes Friday. Joining us now to discuss, we've got Michael Reed, who is a U.S. economist at RBC Capital Markets. Great to have you here with us this morning.
Thanks for having me.
Certainly. So let's talk about the setup, kind of coming into both the employment situation side and then the inflationary side that we're going to see, as the Fed is going to be paying attention to both what the administration does as well as what is coming through in the employment data. What do you think is taking priority for their thinking right now?
Yeah, I mean, it's a really tough situation for the Fed, to be honest. You have inflation that's still sticky, and what's going on right now with respect to the tariffs adds some risk that inflation stays around this 3% year over year pace. But then you think about what's happening on the labor market. You have job growth that is slowing. You have this added worry now that DOGE layoffs are impacting the broader labor market. So, that typically might be something the Fed may want to provide an insurance cut ahead of. But with inflation where it is, it just makes it very hard for them.
Michael, when it comes to tariffs, I guess the economic impact, I know you've run some modeling there. What do you think that looks like?
Yeah, so if we do see kind of these tariffs that Trump has described, 25% on Canada and Mexico, those are going to make it very hard for the North American economy. In fact, we've modeled on the Canada side, even at 3 months, that would push Canada into a recession if we saw tariffs implemented for that long. For the US, not necessarily as impactful, but still we estimated it would slow growth basically to flat. So that is to say, we wouldn't necessarily enter a recession, but growth would be very sluggish.
Even without tariffs enacted right now, and of course this week is going to be the critical time marker for that and whether they get implemented or not, is it already having an impact that we can quantify from the consumer mindset side?
Yeah, so we're seeing some signs. I think you mentioned some earlier on the consumer confidence side. When you think about things like inflation expectations, those were quite elevated last week. And when you think about how that impacts consumer behavior, they may start to front run some of these tariffs. We saw some advanced trade report come out last week, showed there was a surge in goods that may be reflective of some of this front running. But I think more importantly, what we've been watching as it relates to the consumer is their ability to continue to spend at this pace. And what was concerning, I think, when you look at the details of the personal income spending report, it's that you had a notable pullback in January. You had real spending down 0.5 month over month. And we think that was payback for what we saw in December when consumer credit spiked. In fact, that was the largest increase in consumer credit in the series history. A lot of that came from revolving credit, which is reflective of credit card spending. So there you have to start worrying about, these folks, do they have the ability to continue spending? Are they going to load up on credit card debt and then worry about paying off the interest on that later? So these are some of the things that we're thinking about. On top of that too, when you look at the personal income side of things, that looked quite strong. But when you dig into the details, it wasn't the wage component that was driving the strength. And this is kind of adding to our narrative that we've been following and talking about in this kind of K-shaped economy. When you look at what drove the growth, it was things like dividend, rent, and proprietor's income, which are skewed more towards higher income households. When you talk about kind of middle class, most of those income gains rely on wage income. Those weren't as strong. So there, if you have a continued slowing in the labor market, wage growth isn't as strong, you just have a continued bifurcation in terms of the ability for the folks who are spending and using credit to pay that back. So at some point, they're going to have to decide, am I going to pay down my debt, or am I just going to pull back on consumption altogether?
So, Michael, how should we then be thinking about tariffs in that context? I guess just in terms of the inflationary pressure that they may cause and whether or not they're going to exacerbate some of those trends that you're already starting to see.
Yeah, it's hard to kind of quantify it in terms of the consumer, but one thing we do know is tariffs generally are disproportionately more burdensome on those middle and low income consumers. So you add on kind of this dynamic where already income growth is weaker for those households, and now they're going to face a higher burden of inflation on top of what we've already seen. In fact, we've been modeling this. When you think about some of the biggest drivers of inflation over the past couple of years, it's been things like shelter and food, and that has disproportionately impacted those same households. So this is just adding more inflation to those folks who are already struggling right now.
All right, Michael Reed, we appreciate you taking the time to join us here on Set today.
Thanks for having me.
Coming up next on Morning Brief, we're going to be counting you down to the opening bell on Wall Street. Plus, we break down the latest in the crypto markets as President Trump announces new changes to strategic reserves. And Capri shares jump as Prada moves closer to purchasing the company. We got those details and more coming up next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Kroger CEO Rodney McMullen resigning after an investigation into his personal conduct. The company says the personal conduct was unrelated to the business, but was inconsistent with its policy on business ethics. Lead director Ron Sargent was named chairman and interim CEO effective immediately. Mark Sutton is going to be serving as Kroger's lead independent director, and they expect full year identical sales without fuel to be at the high end of its guidance range. We also got that update in tandem with this release.
Yeah, limited details there just in terms of exactly what this does involve. But again, Ron Sargent was named chairman and interim CEO. And you take a look at his past, obviously, given the fact that he does have extensive experience. He's saying that he has been the director since 2006. He also formerly served as the CEO of Staples. But again, when you see a change at the top like this, we are looking at a bit of pressure here in Kroger shares. Year to date, you are looking at some gains here. But again, in the statement here to Yahoo Finance, and Kroger naming its interim CEO, Ron Sargent, saying, quote, "My decades here have given me a full appreciation of what makes Kroger unique. I plan to be a steady but active hand in the execution of our strategy." We'll see whether or not that alleviates some of the concerns, some of the unease that we did see creep up here in shares earlier this morning. But again, a change at the top, of course, just introduces some questions just in terms of the fact as to ultimately, as they do conduct this search for a new CEO, whether or not that strategy behind Kroger is going to change much, if at all.
We will see.
All right, let's take a look at Capri. Capri reportedly moving closer to selling its Italian luxury brand Versace to Prada. According to a Bloomberg report, the companies have agreed to a price of $1.6 billion. Now, this comes after Capri's planned $8.5 billion merger with Tapestry. That fell apart at the end of last year, back in November, after a judge backed the FTC's opposition here to that deal. You're looking at shares of Capri here up just about 8.6%. We'll see whether or not this goes through. But again, when you take a look at the fact that it looks like they have agreed on a price here, obviously a step here in the right direction. You are seeing Capri shares move to the upside, maybe some relief as to what the future, at least of part of this company, could potentially look like.
All the research I was doing on this story coming into today's show, all of my ad experiences online are going to be totally skewed towards the luxury end, things that I'm just not going to be able to purchase, and that's going to be sad for me. It's something I'll report back on, maybe not. But ultimately, one of the things here that we're also thinking through is just the environment that this is taking place within. You mentioned the deal that ultimately Capri had to move away from, and then now this potential for Versace to be brought on with Prada. This is considerable, especially knowing the larger luxury, state of luxury right now. Bain & Company had actually looked across some of the overall luxury spending that saw a slight decrease actually globally in 2024, speaking to, of course, the end of the consumer that still has more propensity or funds to and willingness to spend, but still, even among that consumer, there was a slight decrease. And specifically looking at the luxury goods market, the core of the core, as they call it, luxury segments, and the focus on analysis, actually, that saw its first contraction in 15 years. So that just going to show, even at the luxury end of the consumer mindset right now, how much of those discretionary dollars are even still being said within the household or at the individual level to say, you know what, maybe I don't need that new luxury handbag right now. I got another one. Or maybe I'll go get a fake one and just store the luxury one.
And the argument with Capri is that it's kind of in that middle ground, right? Yeah. It's not the ultra high end of the luxury goods, and that's why it has been struggling a little bit, especially when you take a look at one of its brands like Michael Kors. Obviously, it also owns Jimmy Choo, but when you come to some of its most recent results, they're having a trouble here reviving some of that sales growth. The guidance that they gave didn't live up to the street's expectations, and we obviously have seen that weigh on the stock here. So investors very much hoping and looking for Capri to do something that would make sense, and at least for right now, it looks like they're a bit encouraged by what this could mean here for the company.
That was something that I learned this weekend, by the way.
What?
That people buy fake bags and then just store the real one somewhere else.
Saving it.
Look.
Could be a smart investment.
That might be my new strategy. We're also watching crypto stocks here today, taking a look at those big names after President Trump announced the creation of a strategic crypto reserve. This comes after Bitcoin dropped below $80,000 last week. Joining us now, we've got Andy Baer, who is the CoinDesk Managing Director. Andy, great to have you back here in studio with us. What does this mean for the crypto market broadly? This was campaigned on, this was expected. So is there any shock or surprise value to this?
First of all, how was your guys' weekend? Do you have a good weekend?
It's chilly, man.
We don't have weekends, so it's always nice to hear somebody
I'm loading up on fake handbags,
yeah,
Andy.
No, I don't think we've had a weekend in 6 months. It was 10:24 yesterday morning. This first post on Truth Social came out with the president, and I think the big difference is that other tokens besides Bitcoin and Ether were mentioned as being eligible or as being attractive for a reserve. Solana, XRP, and Cardano. We actually have an index. These aren't arbitrarily picked. We have a large cap index we call the CoinDesk 5, which actually includes those 5 assets in it, which supports better part of $1 billion in assets. So they aren't arbitrary names. They were a surprise to the market. The other interesting surprise was that the first social post failed to mention Bitcoin and Ether, and about an hour and a half later, the president said, "Oh yeah, Bitcoin and Ether also." So there was a little bit of concern in the meantime as people were sipping their Sunday morning coffee and looking. It's a great step forward in the last of a series of very crypto positive news in the United States.
And did you know how much is going to be bought or how it's going to be funded? I guess how should investors be thinking about that?
The details of this and what kind of congressional action would be required, all the details are way in the future. I think we're talking about an intent here. The president also, or the White House also announced that there would be on March 7th a crypto summit led by the crypto czar David Sachs and other folks. So I think a lot of the details might be hammered out there. But the idea that the government might reach beyond Bitcoin into a portfolio of digital assets, of important digital assets, and try to store things there is interesting. Just think about Bitcoin's almost a $2 trillion asset, right? So when you think about size, the smallest Cardano is only about 35 billion. So way smaller. So you have to think about scaling on a market cap basis. You'd have to have a lot more Bitcoin, a lot less Cardano. Yet Cardano was the biggest performer on yesterday's news.
So then skepticism surrounding this obviously makes a lot of sense, just given the lack of any of these types of details.
I think there is hesitation. I think, look, it was the first time I think that other assets had been mentioned. I think the idea that you would want to index what you're getting and not only get Bitcoin as a store of value, but actually invest in future of finance. Solana, Cardano, and Ethereum are all layer 1 smart contract blockchains, right? They really kind of support the applications which are going to change our lives in the future. So investing in that kind of technology, yet not particularly picking one winner in particular, I think is a good move. We, of course, love indexing. We're an indexing company, so we believe in that kind of style. So I think it's very positive. A summit that goes beyond Bitcoin shows that the United States, as the president said, wants to be the crypto capital of the world.
It's so interesting because I was reading through the Truth Social post that is well circulated now, and talking about us being a leader in holding and stockpiling of certain, and there it is on our screen for everybody who hasn't seen it, trying to make sure that this strategic reserve includes all these coins, but making America the crypto capital where we already hold the most Bitcoin. We already have, whether it's via seizures or just holdings right now, we have the largest stockpile. And so what extent will we need to see this be piled on top of for it to really make sense for those who were banking on some sort of massive move to the value of existing in circulation Bitcoin?
The bigger picture is these layer one smart contract blockchains really will support the applications that change our lives. Solana has been associated lately with meme coins, but has a lot of different potential. Cardano has potential. Ethereum is the biggest smart contract platform that has attracted banks and other financial institutions to participate. What we need to do is accelerate how blockchain technology can change how finance works, how consumer things works, how payments work, how a lot of things work, and having the government be overtly kind of supportive of this in terms of a summit, in terms of actually holding these things, just helps send a good message that this technology shift, which we still believe is on the same scale as the internet or mobile technology, is going to be supported, and is going to be supported overtly by the government. So I think whether the numbers and how much they're going to buy and how much that is going to support the price, that's kind of, it's interesting, but it's sort of, it's window dressing. The real idea here is to become the crypto capital of the world. We want to advance these technologies forward.
Andy, thanks so much for taking the time here with us today. Look, I'm wrapping my head around all of it. So I just got ChatGPT
changing by the
over
hour.
weekend. Yeah, a lot of stuff going on. All right, Andy, appreciate it. Coming up, we'll count you down to the opening bell on Wall Street. Stay tuned. Welcome back. You're taking a live look at the opening bell on Wall Street and in Midtown Manhattan, where you've got Euphoria, not to be confused with popular hit show Euphoria. Euphoria ringing the opening bell at the NASDAQ with some funfetti in the air, and Citi ringing the opening bell at the New York Stock Exchange, kicking off Women's History Month here in March. All right, taking a look at the major averages as we begin today's trading activity. The Dow Jones Industrial Average up by about 0.2%. The NASDAQ Composite, that starts off higher by about 0.4%. We'll round that off too. And the S&P 500 up by about 0.25% to begin today's trading activity. I want to just zoom on over to some of the sector activity and hustle with my time that I have here towards some of the leaders and laggards. The laggards right now on a sector basis, staples pulling up to caboose. We do have more leaders than laggards, though far more. And materials is leading that pack. It's up by about 0.9%. Host of other names seeing some fractional gains here out the gate this morning. Let's take a look at the NASDAQ 100 right now. If we were to put the entire composite up on here, you would be squinting like nobody's business. All right, taking a look at some of those mega cap tech stocks. You're seeing Apple trying to find its footing out of the gate here this morning, oscillating between gains and losses. Google right now, Alphabet, whatever you call them, calling them up here right now by about 0.8% in the green. Meta also seeing fractional gains. Amazon higher to start off today's session. Nvidia, though, that is down by about 1.7%. I was taking a look at this year-to-date chart here just while we were having one of our conversations with guest Sam Stovall of CFRA a little bit ago, and I mentioned Nvidia. I wanted to check in on Nvidia. Year-to-date, still down by about 8.5%, so we'll continue to keep tabs on that one. That company just reported earnings last week. And then lastly here, let's just take a quick look at the Dow 30 components to begin today's trading activity. It looks like we have more gainers than laggards right now. Boeing, that's leading the pack. That's up by about 1.2% to kick off today's trading. And then additionally, Nike here up as well as Honeywell, I believe, as well. That's up by about 1.3%. Those leaders being jousted over as of right now. But the laggards still Nvidia. Jared, let's get on over to you with a deeper dive on what's taking place out the gate this morning.
Thank you, Brad. Just a quick reminder, we are coming off the best day for the NASDAQ 100, the Dow, and the S&P 500 since January. I'm going to put a year-to-date chart. Here's the S&P 500. You can see we just dipped into the negative at the very tail end of February, but we are now back in positive territory for the year. Here is the NASDAQ still looking at year-to-date losses, so we'll have to see what comes of March. As I outlined last week in a couple places, I have two different models for March, and one of them is a little bit higher, one of them is a little bit lower at the end of the month, but April is when we typically see the big rally that we like to see, at least for the bulls. Here's a 10-year T-note yield. This is also year-to-date, not doing a whole lot. It's up 1 basis point. The movement today is in the dollar. A lot of times these two assets move in tandem, and today it's just the dollar. That's down 2.4% year-to-date. That is generally speaking, that is a tailwind for for risk assets, and it looks like that's what's happening today, this continuation rally off of Friday's good fortune. And today we had tech and cyclical stocks leading in the early going. That was pre-market. Now it is mainly materials and industrials, so that's a cyclical component there. But I wanted to take a quick look at financials. Here's a year-to-date look at financials. That should be good enough. Yeah, 52.26 was the prior record high, so that is a fresh intraday record high for financials, and you can see they're up 8.2% this year, and some of that's deregulation, some of that is just the cyclical rally that we've seen here, and maybe a little value thrown in. Want to get to the NASDAQ 100, where we see Tesla continuing its gains from Friday. Here's the year-to-date too. That's down, Tesla's still down 25%. But critically, this low that we had on Friday, that was right off of the 200-day moving average. That's a key technical level, and that means the bulls are still in control long term. The short term is still down, but long term bulls are retaining that edge. So we'll see if we get any continuation off of that. And we're seeing a lot of movement in the metals today. Not huge, but for instance, palladium here, that just caught my eye. That's up 4.6%, platinum too. But silver is what I was looking at, that other industrial metal. Here's the year-to-date, up 9%. Silver having its biggest rally today since January. It's up almost 3% today. And then gold and copper are jumping as well. I'll show gold because that has been hitting records this year, although not within the last few weeks. It has found support here, maybe off of 2,800 or so, and you can see just shy of 2,900. 3,000 is a big number. Hasn't reached it yet, at least not priced in US dollars, but we'll see what the cards hold for March. I'm going to be doing a deep dive into gold in a few minutes here. Finally, I'm going to leave you with crypto. Bitcoin up 8.7%. This is a 20% jump off of that low, and there's another 200-day moving average story. So is Bitcoin in the clear? Not quite yet, but if it manages to squeeze above 100,000, that's 8,000 higher. If it manages to squeeze above that, I would say the longs are firmly back in control there. Seana?
We'll see how this all plays out. All right, Jared, great stuff. Thanks. So now for today's strategy session. Now this year's market volatility mirroring what we saw at the start of last year. And according to our next guest, each sell-off then offered investors a rewarding entry point. Joining us now is Adam Johnson. He's Bullseye American Ingenuity Fund Portfolio Manager. Adam, it's great to have you here.
Likewise.
At the desk. So is that going to be the case this time around too, you think?
Yeah, and I think that's what we're seeing today. It's amazing to think that over the previous 10 sessions, the NASDAQ was down almost 10%, right? I mean, just day after day, and I kept looking at my screen and saying, yep, we're down again. And yet, that's exactly what we saw on 3 occasions last year. Each was a wonderful buying opportunity. In the moment, it never feels good, and I get calls from clients and they say, I mean, is this it? Is it over? No, it's not over. NVIDIA, actually, as much as the NASDAQ went down last year 3 times, NVIDIA went down even more, 30%. 3 times, and each time it came back. So I think you have to take the long view.
And so a lot of people have taken that long view, and long Mag 7 is the most overcrowded trade we know right now, essentially over the past 2 years. So where else are there opportunities to maybe outperform, especially knowing the pullback that we've seen in some of those overcrowded trades?
Well, I think what you're getting at is something that was impressed upon me by an early mentor. And he would ask every time someone went to interview with him, he would ask one question. And the question was, how do you make the most amount of money on Wall Street? And the answer that got you the job was find a theme and leverage it. AI is the most powerful theme in the market right now. We're all talking about it. I don't have to explain to you or to anybody why it matters, right? Just as every company became an e-commerce company 15 years ago and then a cloud company 10 years ago, now every company is becoming an AI company. So leveraging that theme is a very powerful way to make money. NVIDIA became the obvious one. Stock's up tenfold because earnings are up tenfold. And then you start thinking about what AI requires. Data centers. Again, something we're all talking about. So you could actually put together an entire portfolio just around data centers. GE Vernova, ticker GE, which uses nat gas to produce electricity on site. That powers the data centers. Sterling Infrastructure, STRL, actually builds the data center themselves. Supermicro, a company we've been talking about that got crushed, now trading at 10 or 11 times earnings. They assemble the AI infrastructure that you need to actually become that AI company that they all want to be. So, if you want to talk about where to go that's outside the Mag 7 but still kind of related, I'd go to AI and data centers.
Adam, how should investors be thinking about that valuation aspect to this? Because I think that is a huge question, especially when it comes to some of these AI names. And obviously, it's a very stock pickers type of market right now, as many would argue. But clearly, that story and that narrative changes depending on who you're talking about.
Well, the way I think about it is the price you pay for the growth you get. So, for example, you can buy the S&P 500. It's trading 21 times earnings, and you get 12% growth. Okay, fair point. That's our sort of benchmark. Well, you could go out and buy NVIDIA, trades at 30 times. You say, oh, that's a lot more than 21. Yeah, but it's growing at 60%. Supermicro, trading at 10 or 11 times earnings, growing at 60%. So you say to yourself, well, what am I willing to pay for the growth I'm getting? By contrast, Palantir, which I will not touch, I wish I had at $8, I didn't, now trades at somewhere around 180 times earnings. Really? With 15% growth? So you're gonna pay however many more times that is than the S&P 500, 7 or 8 times more than what you'd pay for the S&P 500 for marginally more growth? That doesn't make any sense to me.
Where do you think is the state of the growth narrative for companies right now, especially knowing that with the amount of the earnings season we've moved through, the revisions, and it's not atypical to see in the first quarter revisions to some of the full year outlooks, but we've gotten more revisions to the downside than normal, even during this period.
Yeah, we have, and yet the growth that companies put up in the fourth quarter was 12%. Actually, I think 12.3. And the margins, critically, profit margins were 13%. That combo, 12.3% growth, 13% profit margins, that's the best we've seen since 2021. You know, that acceleration coming out of COVID. And while, yes, you're right, guidance has disappointed some, I would say, that's a fair characterization. We're still talking about 13% growth, which is better than the 12.3. So, you know, it's very popular to sound skeptical. Bears always sound smarter than bulls. You know, people just assume that the bears see something that the rest of us don't. But in this case, I don't agree with that. You know, just take it at face value, don't overthink it. Market down 10% on the heels of 12.3% growth with 13% growth likely for the next reporting season. Buy it.
Yeah. No bears or bulls on this desk, just eagles, ultimately. Adam, thanks so much.
Oh, thanks for having me.
Thank you.
Good to see you. Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at an economic indicator flashing a warning sign. Hey, Maddie.
Hey, Brad, that's right. The U.S. economy on track for negative GDP growth in the first quarter. That's according to the latest Atlanta Fed GDP Now forecast. You can see here that huge drop off in indications of where we are heading for that GDP number for the first quarter. And just to broaden this out a little bit here, this is the lowest reading that we have gotten in the last decade ex-COVID. So definitely flashing that warning signal. But in order to not freak people out too much, let's talk about what goes into this number. So a huge drag on this number this month was in the form of companies preparing for tariffs. We saw a huge drag on net exports as companies are holding on to inventory. That weighed on this number a lot. But we also saw consumer spending dipping, and that weighed on this number a little bit too, not as significantly. So the question is this tariff noise or is this something more sinister? That's something that we're going to be continuing to talk to our sources on the shows a lot about throughout the course of this week. If it is something more sinister, if it is consumer spending that is weighing on this number, that could be a concern, particularly in retail earnings week, which we are heading into now, and something that we will hopefully get more color on as we hear from those companies. Also, lastly, want to mention one of the reasons that we take a look at this is because 2 quarters of negative GDP growth plus a lift in unemployment, that is the formula for a recession. So again, just a warning sign, but something to continue to monitor.
Certainly something to watch here. All right, Maddie, thanks so much. Coming up, we're taking a look at the state of retail ahead of a very busy week of earnings. We've got that for you when we come back. A busy week ahead for retail earnings. Target, Costco, Macy's, Best Buy, many more are set to report their results. And this comes as the latest read on inflation showed that consumer spending actually fell just a bit. And this came despite moderating price increases. Joining us now with his read on the sector at large and the consumer, we want to bring in Jerry Storch. He's the CEO of Storch Advisors. Jerry, it's great to talk to you. So I think the big question here for so many investors is whether or not we've seen a peak in the consumer and whether or not that picture, the macro picture, is starting to deteriorate just a little bit. What do you think?
Well, I think the consumer has been struggling for some time. Debt levels are all-time high levels. As you know, inflation has been weighing on consumers. There was a burst of optimism following the election. Even people who didn't back President Trump thought he might be better on the economy than what we've seen for a very long time. But what we really see is nothing's changing. And even though I see that data where we say, February or something was down versus the prior month, it was up about the same amount year over year, if you look at retail sales, as it's been every other month in that kind of 3%, 4% at the best month kind of a range. So I don't think it's necessarily slowing down, but I think we have just so much time for optimism to last until people are going to say, what's going on here? Nothing's changing.
Yeah, and Jerry, I mean, and households are continuing to need to outlast some of the elevated expenses that they're seeing in housing and utilities, as evidenced in the most recent personal income outlay here, and PCE, I should say, as it's more colloquially and commonly known. At the end of the day, when you have that extent of consumers that are feeling pressure on the things that they need to purchase versus the wants, what are the retailers that you would be most looking out for the wants category to take a serious hit?
Yeah, well, look, I agree with your diagnosis, by the way. And so consumers are, everyone says, oh, consumers still spending. Well, most of the spending is on things they have to buy, like rent, healthcare, and then required purchases like at Costco, Walmart, things that are consumables, groceries, value. So therefore, by contrast, the people you expect to suffer are people like Target, for example, who really has not been doing as well as Walmart for quite some time because they rely more on products that you don't have to buy, that are more discretionary in nature. Same thing for department stores as a group. For specialty apparel, there can always be some winners who have really hot products. But if you look at the category as a whole, that's going to continue to struggle. So it's the discretionary purchases that suffer in this kind of environment.
So, Jerry, I guess the downside or what that potentially looks like here this earnings season, how much of that has already been baked in, do you think?
I think most of what happened over the holidays, people know. Yeah. There's no real surprise, about who had a good holiday and who didn't. The question is going to be what kind of guidance are we going to see? And most of the guidance we've seen from retailers has been fairly conservative. And the question is that them just being smart? Because obviously in this environment, who would be crazy enough to guide, wildly optimistically, or in fact, do they have reasons for believing it's going to be a very tough year? And I think it's probably a little bit of both. Things are not ebullient right now. There's no doubt about it. So it would be nutso to come out with very high guidance right now. And I don't expect to see it from anybody.
So what do you think just the tariff impact is going to look like? When, as you, obviously, the experience that you do have, executives trying to navigate this very uncertain environment, how are they then factoring that in here for the quarters to come?
Look, people don't know. We don't even know what tariffs we're really going to see yet, and certainly don't know the impact. I will say my own belief is that the sky is not falling. When we look at the tariffs that President Trump imposed in his first term, they didn't have kind of a draconian effect on the categories that are affected on the economy as a whole. And there were some fairly significant tariffs during that period. But what we saw is most of the costs were indeed sort of muted through negotiations with suppliers. Now we're adding on top of that, and so it'll be harder to pass as much of that along, but some of it will stay with suppliers, some of it will be substituted for other products, some will be produced in different countries. The one thing I know for sure, let's say they say it's a 20% tariff, that's not 20%, keep in mind, on the retail price, that's 20% on the import cost, which is only a portion of that. So it won't be quite as high as kind of the sky is falling scenarios. But in some businesses, take auto parts or something where there aren't clear substitutes, I think you're going to have problems. A lot of consumer goods, there are substitutes. It won't be quite that bad. And so I guess I don't think the sky's falling. It wasn't as bad as people thought it was going to be last time. I don't think, whatever it is, we don't even know yet, I don't think it's as bad as people think now.
What are the keys to the trade for retail right now from your perspective?
Well, I'm still sticking with quality. I know, that people believe that maybe Costco is overvalued now. They've done too well. Same thing with Walmart. I mean, Walmart, for gosh sakes, is up 68% on a 52-week basis. Can you believe that? Walmart is up like that. Or TJX is way up, or Amazon is way up. But I know they're going to perform fine. The question's going to be, is the valuation too rich right now after everything that we've seen over the past year? And I'd still rather be with quality than go after somebody who's, kind of in trouble in this kind of environment and grasping for for life preservers, and it may turn out to be an anchor. So I'd still stick with those folks who have been performing really, really well for a long time, not because the upside's so huge, but because the downside probably isn't.
All right, well, fortunately, I've got my floaties. Jerry, thanks so much for taking the time.
My pleasure.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Southwest Airlines downgraded to underweight from neutral at JP Morgan. Analysts warned in a note that less government travel and cautious consumer spending could impact Southwest and other airlines in the months to come. The stock's price target was left unchanged at $25. Shares are lower by about 0.4%.
Plus, it could be a good time to buy Chipotle. That's according to a new note out from Morgan Stanley. They upgraded the stock to overweight from equal weight, calling the company a, quote, quality large cap growth compounder that's been weighed down by short-term headwinds. Now, analysts expect the company's catalysts are going to boost performance in the months ahead.
And finally, a tale of two ratings for Deere. The farm equipment maker was added to Goldman Sachs' conviction list. Analysts believing the stock's sluggish performance is headed for a turnaround, and now's the time to enter. But Baird analysts see it differently. They downgraded Deere to hold, saying the timing of recovery isn't certain thanks to weak commodity prices and tariff uncertainty.
All right, well, that does it for Morning Brief, but keep it right here on Yahoo Finance. Catalyst is coming up next.